So I think there was this kind of long-term mindset across a lot of the management teams that led to wise decisions that many of the businesses also were quite acquisitive and they'd acquire bolt-on acquisitions, which could really propel the growth. And I think it's quite hard to find a multi-bagger just on the financial metrics alone. Yes, of course, you might be lucky enough if you're screening and buying a share just based on the numbers that they could do very well. But if you really want to go and hunt for multi-baggers, like digging into the business models is really important. The business model, the management, the moat factors, these are the kind of qualitative traits that I think are really important in finding these kinds of companies.
Hello and welcome to the Fund Your Retirement podcast, a guest-led podcast aimed at sharing insights and strategies that help you build long-term wealth. Today, I'm delighted to introduce Ed Croft. Ed is the co-founder and CEO of Stockopedia, whose goal is to help private investors beat the market. Ed is here to talk about the metrics that drive long-term compounding in companies, how you can find those companies today, why he's optimistic about the UK stock market, why his investing style has gone full circle back to being more of a stock picker, what he learned after going through a 60% drawdown during the financial crisis, and of course much, much more. So Ed, thank you very much for joining us on the show today.
Thanks for having me, Lee. Great to be here.
So Ed, let's start with your investing journey. How did you get started?
Well, I started my investing journey a long time ago now when I was at university, where my dad had set up a PEP for me, which was the precursor to the ISA. And I used some of that as beer money at university, but actually went on after uni and I started getting really into the stock market. And I read lots of books about investing and all of Jim Slater's books, like the Zulu Principle. And that really led into a bit of a breadcrumb trail of other readings, which got me really hooked. And so after uni, I went into the city and I tried to sort of hustle my way in. I'd read a sciences degree. I was always very numerate and I wanted to go and see what I could do in stock markets. So started off in an asset management firm and then I ended up getting a role in Goldman Sachs in their private clients department. And we were running, just amongst 3 or 4 of us, running about $2 billion in private client assets, very high net wealth individuals. And that was all late 90s. After the Asian crisis, through the dot-com bubble. It was a really exciting time in markets. It was a real growth market and a real bubble and a hell of an education. And that really opened my eyes to many things in investing. But then after that, my mother actually died and I ended up leaving and I went to running a small fund and family assets and my own personal account and started becoming much more of a private investor without my tools that I had in the city. And I'd sort of look around on the web and try and find good services for private investors. And there really weren't any that were treating me the way I wanted to be treated. So many of the platforms had bad data and I wanted really good data because I wanted to invest more quantitatively with good metrics. And there was a lot of advertising everywhere. And I thought maybe we could do this better. So that really led to the founding of Stockopedia, which I've been running ever since. And we opened to subscriptions in 2012. And here we are at the end of 2023, and we've been going from strength to strength, really. And we've just got a wonderful community of private investors. Many people, I think, are the best minds in investing in the UK and also some internationally. So that's really what I do. And I just love markets. I love financial data, and I love trying to beat the market. So that's really the journey of how we got here.
Brilliant share, Ed. Thank you. So we are going to cover a wide range of topics, one of them being the excellent research that you and the Stockopedia team have done in what creates a multi-bagger. But first of all, before we dive into that, I always like to try and start at the very beginning. For someone who's new to stock picking or someone who's new to this podcast, we're going to mention the word multibaggers quite a lot, and they might not know what a multibagger is. And I know that the private investor community are probably quite well aware what a multibagger is. But for those that are newer to the community, newer to this podcast, can you explain what a multibagger is, please, Ed?
I know it's a great question. And really it's something that comes from across the pond. I first came across the phrase 10-bagger in Peter Lynch's One Up on Wall Street, which is a book I've read so many times and I recommend it for everybody. And I think he said that in Wall Street parlance, 10-bagger is a stock in which you've made 10 times your money. So you can think of it as taking your 1-bag investment when you buy a share. Let's say you put in, call it 10 grand and you buy a share, and taking that 1-bag and doubling it, tripling it or more. So doubling your money would be a 1-bagger, 5 times 5-bagger, 10 times a 10-bagger, even the elusive 100-bagger. something that does happen. It's not been seen. It's a rare breed in UK markets in recent years, but there have been many 100-baggers. And in fact, there are even books that are fantastic that are actually titled 100-baggers and 100 to 1 in the stock market and books like that. So there's a lot of literature about trying to do very well in the stock market in this way, but it's a very good sort of term for trying to multiply your original investment.
That's a really good explanation. And yeah, I'm sure that the audience now are quite interested in learning more about how they find these multi-baggers, which is pretty much the essence of the report and the research that you and the team had a real deep dive into what creates these
Absolutely.
multi-baggers, the foundation qualities of these businesses. So it'd be really interesting to hear what drove you to start this research off.
Well, I think I've always been somebody who is extremely interested in learning about what's worked in the past and trying to apply it to the future. And really, that's very much the ethos of what we do at Stockopedia, is that it's based on what's worked over the last 100 years in stock market and trying to actually craft the service in a way that actually helps people apply those things for the future. Now, history doesn't always repeat itself, but it does often rhyme. And so I thought, actually, we started archiving our financial database back in 2013, and now it's 2023. We thought that's 10 years of market history that we've got in our own financial database. So all of the fundamental and technical criteria we're actually storing on a daily basis. And we thought, why don't we look and see what the top performers were in the last decade and look at their financial criteria on day one and see if we could actually see any common themes, see what the fingerprint of those shares might be, and then also track those financial criteria through time to see what changes. So that was really the kind of motivation, is to try and figure out what those fingerprints or traits of multi-baggers might be, to help us try and hunt them in this market environment.
Over what time frame was it?
It was a 10-year period, and the rules of the game were quite straightforward. We decided to exclude really small companies, the micro caps. We looked at all the companies above a 50 million market cap at the start, and we also required them to have an active listing on the start date and the end date of the period, 2013 to 2023. So any interim IPOs or delists were actually excluded from the study, and it was all in on the London Stock Exchange and UK market. So that was really the kind of the parameters of the study. And we looked at their split adjusted stock returns through the entire period and then just ranked the market for their performance and then try to figure out what the traits of the top ones were.
What did you find then? Was there quite a lot of tech stocks in there? Was it a lot of hot stocks that we see in the news more often than not?
Well, I think this is one of the interesting things. There are a lot of myths about multi-baggers. People think they're only found in trendy or disruptive sectors like tech or biotech. And that's partly because in America, it's true. There have been some huge winners in the technology sector, and often very glamorous and sometimes some really speculative stocks have gone on these kind of big runs. And many people think, oh, high risk, high reward. I've got to go out and take lots of risk if I want to make money in the stock market. But we found those were all myths. Actually, that wasn't what we found at all. We found that these companies all had pretty simple, scalable business models in sectors that were kind of more traditional. Yes, consumer, often very consumer facing. 5 of them had strong consumer facing brands or business models, but we also found a few industrials in engineering sector and so on. Only 1 in healthcare, and that was a vet consolidator. We didn't find any of the top 10 in energy or basic materials like mining, and none in the tech sector. And I remember I'm looking at the top 10 here rather than actually the sort of, let's say, top 50, in which you might find some from those sectors. But generally, that was the kind of overall picture.
So what did you find that actually drove long-term growth in these companies? What was the actual key attributes that really turned these companies into multi-baggers?
I think it kind of splits into both the more financial or quantitative characteristics and the more qualitative ones. So if we start with the more financial characteristics, that first up, they were all small companies at the start. So they all had a market capitalization, which is the value of their shares, of between 50 million and 358 million. So they were generally small caps at the start, and the average was about 168 million. And over time, they grew into having an average of 1.67 billion market cap. So they all on average sort of 10 bagged. So they were quite small at the start, and that gives, acorns can grow into oaks. So they could really go on that journey of growth. They were all profitable at the start, and they were all dividend paying at the start, which actually really surprised me. They were also very low debt companies. On average, they actually had net cash. I think that's partly because they were profitable cash generative businesses at the start, and they were able to grow their sales and earnings quite strongly. they had to have this kind of sales growth runway, which they could expand into, and their earnings would grow faster than sales. But also, we found they were on quite low valuations at the start. So low price to earnings ratios, which actually meant that they were almost valued quite cheaply, like value stocks. And then the market kind of gradually grew in its awareness of these companies and started putting them on higher and higher valuations. So they were ended up being valued more like growth stocks by the end. We found that the brokers, the analysts in the city were always slightly behind the curve. So they were constantly upgrading their forecasts for what the profits might be next year. And the companies would generally beat the analyst forecasts. So we found that these were the general kind of financial traits of those multibaggers. And I think that's a really important set of lessons just there in terms of what you would generally and should look for, kind of more high quality, reasonably valued, good momentum shares.
Yeah, and given the current market conditions in the UK, there's an awful lot of companies that have got low PE ratios, isn't there? And so,
Absolutely. I think that's one of the great things about the market at the moment after really a 2-year bear market in small caps is that valuations have been driven really low. And I think it's actually an opportune time to be looking for these kinds of stocks because there's a lot of forced selling by funds and fund managers who've had redemptions. And that's really pushed down valuations in really actually quite promising businesses to the point where I actually think it might be a spring that might bounce back over time. So yeah, quite exciting.
mentioned there was two factors that drove long-term compounding growth.
Also, the more qualitative aspects. So we found that many of the companies were benefiting from what you might call competitive advantages, or Warren Buffett calls them moat factors, which, if you imagine you've got a castle, if you have a really profitable business, it's going to be under siege from competitors. And so it benefits a company to have a moat, or a castle to have a moat around it to ward off the competition. We did find that obviously with some of them being consumer facing, they had brands which they would invest in strongly. So take an example would be Jet2, which many people watch things like Love Island and you see them advertising Jet2 holidays, packaged holidays to the sun. And Jet2 at the start was called Dark Group, and it had some other businesses that it ended up divesting, and it just really focused on this one business model, which it really scaled up tremendously well through that 10-year period, and investing in its brand to give it that recognition and the sales growth and so on. So brand was one thing. We also saw it in companies like Games Workshop, which is more of a niche business where people paint figurines and so on and do tabletop wargaming. One of the brands is Warhammer, which is really well known if you do that kind of thing. And so the power of a brand is definitely one sort of competitive advantage. But then there were others that had more ability to sort of incorporate switching costs into their business model and network effects, which I use Apple products and it's really hard to go and switch to another product. And I don't want to. I'm locked into that ecosystem. And that happens in businesses in manifold ways. One of the other companies was YouGov, and they've got, I think, 27 million people on their panels that they poll. And that becomes quite a profound network effect. But also all the data they built up over the years of all the history of all the polls. When businesses start using companies like YouGov, it can be hard to switch. So we found a lot of these different competitive advantages. There's a lot more detail in the masterclasses, but they really help protect higher returns on capital, which allows a company to generate excess profits. And this is a really important factor in multibaggers, because if a company can sustain a high profitability and high return on capital employed, then every bit of profit they retain back into the business, they can then reinvest back into their business model as more capital employed in the business, which then compounds and builds on itself through time. And that's a very important aspect of multibaggers, is that they reinvest in themselves at this high rate of return, and they become these compounding machines. And it depends on how much runway they've got for how far they could drive that. But that's a really key point. The other key point was around management. I was really surprised by this, that the management of the companies, 5 out of the 10 were founder-led in some way. If you look at companies across the whole of the stock market globally, the number of founders running businesses is only about 7%. I found that in some Schroders report online. But 5 of the 10 top multibaggers were founder-led. I think that's really interesting. Maybe there's something there of that entrepreneurial drive or knowing the business inside out, and that really enabled them to also to take more risks and capitalize on certain growth opportunities, but also perhaps invest in terms of capital allocation for the long term, not just for the short term. Because, hired guns can often just be thinking about their options package or something like that. And then the other managers, they had really long tenures. So the other CEOs who weren't founders, often they'd been promoted from middle management and they actually had grown up in the business. So I think there was this kind of long-term mindset across a lot of the management teams that led to wise decisions that many of the businesses also were quite acquisitive, and they'd acquire bolt-on acquisitions, which could really propel the growth. I think it's quite hard to find a multi-bagger just on the financial metrics alone. Yes, of course, you might be lucky enough if you're screening and buying a share just based on the numbers that they could do very well. But if you really want to go and hunt for multi-baggers, like digging into the business models is really important. The business model, the management, the moat factors, these are the kind of qualitative traits that I think are really important in finding these kinds of companies.
Which side did you fall on in terms of your investing style and strategy? Were you much more qualitative or quantitative?
I think I'm definitely a numbers guy. And in fact, my journey as an investor has actually gone full circle. I began very much as a numbers driven qualitative investor. So I always wanted to find companies which had the right sort of valuations and so on. But I would dig into the business models and I'm much more of a stock picker. But I actually ended up in the financial crisis. I ended up getting quite burned because I was so concentrated in just a few positions and I'd completely overcommitted on one position. It was 50, 60% of my portfolio. I am older and wiser now. But then that actually led, especially when we set up the Stockopedia, I actually became much more of a systematic investor. So I started investing very much more quantitatively. And we launched the stock ranks on Stockopedia, which maybe I'll talk about them later, but they really give you a kind of a numeric assessment of quality, value, and momentum. And I started actually running portfolios for myself, for families, based entirely on these measures. Very, very systematic and based entirely on the numbers. And that does very well. And 11% annualized you can do from these sorts of measures. These top 10 multi-baggers, they compounded at 27% annualized. Through the pandemic and to now, I've become much more of a stock picker again. I do a bit of a mix. Some portfolios a bit more systematic and some much more focused on the qualitative. So it's been a bit of a kind of an interesting circle for me.
So, has this research had an impact on your investing then? Has what you've discovered in going through this process, has it had much of an impact on your investing style and approach?
I would say yes. I think I've learned quite a lot doing this study, and this is a lot of work. We put a lot of effort into it. I think there are some aspects which were expected. As I said earlier, I've always studied the long-term stock returns and the power of factors or return drivers like quality and profitability, reasonable valuation. So value investing works, quality investing works, and momentum investing works, which is that stocks, it's a bit counterintuitive, but the stocks that are beating the market tend to keep beating it. So share price strength actually tends to persist. The fact that the multi-baggers actually had these traits, that didn't surprise me. I certainly didn't expect them all to be dividend payers. That was very surprising. And I at least expected some of them to be on much more premium valuations. And the fact that the P ratio being fairly moderate, at least on a forecast basis, was a bit of a surprise to me. I thought some of them would already be valued as growth stars. A couple of things that I've really taken from this are places to go hunting. So as an example, the engineering sector, which I've never really looked into in that much depth, but we've obviously got in the UK a lot of great engineering brains and minds and a lot of skill there. And I think that's, especially in this market environment and with a lot more kind of home shoring, that there's a lot to look into there. But also the power of buy and build businesses and acquisitions as a business model. So as an example, Judges Scientific has been a tremendously successful business. It's in the top 10 multi-baggers. And they went out with this buy and build business model where they'd acquire small niche businesses that are in scientific instruments and buy them on fairly moderate valuations and roll them into its business. And it's a bit of a federated business model in a way. They still operate fairly independently. It's been tremendously value creating for shareholders of Judges Scientific. So some of these lessons, I think, are quite powerful. And I don't know if I mentioned the power of operating leverage. So I came up with something I called the multi-bagger equation, which I think is a really good mnemonic for myself. And I like coming up with models and ideas like this. So I came up with this thing I call the multi-bagger equation. And it's about the three primary drivers of multi-baggers, which are sales growth, operating leverage, and multiple expansion. And if you indulge me to explain this very quickly. So obviously sales growth is obvious. Operating leverage is the operating margins or the margins expanding. So you grow the sales, but if the margins grow quicker, then the profits are growing much faster. And then the multiple is the price to earnings multiple. That's the key valuation ratio most shares are valued on. And so this multi-bagger equation, if you imagine 2 times 2 times 2, if you double the sales, double the margins, and double the price earnings ratio, the multiple that they are valued on, that creates an 8-bagger. And I think it's a really interesting thing and something I hadn't thought about enough. In the past, I'd often tried to focus much more on companies that were at the top of their industry. They had the best margins already, or they had the highest return on capital. But actually, it's the ability of the profitability to grow that really powers the profits of a business. So sales growth and margins expanding is really powerful. So I've learned a lot, actually, and it's really heightened my awareness of what are the factors that go into finding outstanding shares. So that's definitely part of it.
This is fantastic. It really is. And I hope the audience are enjoying it as much as I am. But I suspect that my audience are probably screaming at me right now to circle back and just have a little bit of a conversation about the 60% drawdown in the financial crisis. And I know my audience will be screaming at me to ask about that, because those types of experiences are great learnings as well. I think it's really important to learn and understand how to find and pick these stocks. There's also the part of actually holding them, isn't there?
Yeah.
And that's important, because it's all right. Let's hypothetically say we find a multi-bagger tomorrow. If you don't hold it for the 5-10 year period, that's a good caveat, actually, because some of these stocks did go into a serious drawdown, didn't they, during the pandemic, for example?
They did. They did. There's really, if I can unpack that, there's a couple of things. There's my own experience of really heavy drawdown.
Yeah.
And then there's looking at, I guess, lessons from the multi-baggers. So where do you want to start?
I think let's go with your own experience first, and then we'll look at the actual drawdown of the multi-baggers.
So I went into the financial crisis fully loaded in shares, and actually I had luckily multi-bagged on some of my holdings that I'd been very aggressive on. And so one had grown, actually had more than quintupled up to about 60% of my portfolio. And I honestly thought they were going to continue going to the moon, because they were still on moderate valuations. But I'd managed to concentrate my portfolio. I'd fallen in love with the shares. And I think that is a really dangerous thing to get into, is that when you are doing very well in a share, you end up searching out information that confirms your own biases, and you think they're going to run and run. And some things actually happened that actually ended up forcing me out of those shares. And I was very happy with the outcome in the end, because the one share that I ended up having 60% of my portfolio in, it ended up halving and I got out of it. Because one thing, I needed the funds to buy a house. And if I had held on to it, it would have gone down to 1p, when it got as high as £1.40. So that was a big lesson there. And actually, that was a huge trigger to actually do the research, which actually ended up as Stockopedia. So that pain, which was brutal, and I don't want to ever go back there, I learned so much about portfolio composition, risk management. And I also just ended up researching massively on the behavioral side of investing. And that's why I actually ended up going very systematic for a long time, because I didn't trust myself to not get emotionally involved in the stocks I owned. And I think that is such an important thing. We can all think that we won't become really attached to shares, that we're in control of ourselves. But when you're in a big winner, it can do a lot of things to your mind. And actually, you've got to learn that emotional unattachment to your positions. But, if I go into what you mentioned on drawdowns about these multi-baggers, I did analyze this and the top 10 shares, and they did all have significant falls at some point. And actually, if I include the pandemic in that, the average drawdown was 62% across all those shares. Interestingly, after the pandemic, after they bottomed at the bottom of the, March 2020 crash, where I'd never seen markets drop as fast as in those days. It was extraordinary to watch and suffer through. They were dropping 8-10%. The market was dropping so heavily. And all these shares on average dropped 62%. But then they bounced back and they tripled on average over the next kind of 18 months, couple of years. So there was a huge rebound. And I know many people owned these shares and many sold at the bottom. And it's incredibly difficult to hold through something like that. Being aware of the volatility of the stock market is one of the kind of most important things before you start any equity portfolio, is that there can be something like that happens. And in any 10-year period, you're going to see a very brutal bear market. And I think risk management is a really important thing here. I'll never let a single position become 60% of my portfolio again. And I think you have to try and have a certain amount of discipline to keep your positions in check. Doesn't mean, let's say, something multi-bags, if you are incredibly brave, you may be able to hold it through thick or thin, but it's few who can. So managing the risk in the portfolio is really important, whether that's managing your position sizes and selling down a bit. Selling to the sleeping point is always a rule of thumb people use. And I think even before the pandemic, the average one of these stocks had a drawdown of 43%, which actually does give you many opportunities to buy or add more and average in. But I think that ultimately in the stock market, you've got to have a really good grip on your risk management. I mean, I personally use a range of things to manage risk, and I do a fair bit of market timing analysis to try and assess when it's time to be very aggressive and when it's time to be less aggressive. These are the kind of things you learn over, many years in the stock market. And once you've been through a few cycles, you start picking up a bit of a sort of bag of tricks like this that really help you manage your risk and manage your downside.
Would you mind expanding a little bit on the market timing?
One thing I look at and quite a lot is I look at trend following. I look at the tendency of certain markets to trend. And actually, the UK stock market, the FTSE 100 is it's rich in dividend paying mature companies. It's not really a growth market. Some markets have a tendency to trend more than others. And something I look at quite regularly on Stockopedia is the AIM market, which is full of a lot of very junky stocks, but also has some very good high quality small caps. In fact, 6 out of 10 of the multibaggers were AIM stocks. But AIM as a whole, the AIM all share, has a tendency to trend beautifully. What I would look at is I'll look at a moving average against the index. I'll be much more aggressive when the index is above the moving average than when it is below. And there's a huge amount of literature on this in various markets. The literature is mostly US focused and more S&P focused, which is a trending market, but you can significantly reduce your downside if you are lowering your equity exposure when markets are in a downtrend, and you can get a lot more aggressive with it when they're in an uptrend. I actually wrote a piece last week to say the AIM has just broken up above its moving average for the first time. It had a failed breakout in January, but this is the first time in over 2 years that it's actually gone above that moving average that I track. So these things are quite useful, and it can be very painful staying more heavily in cash. One family portfolio I run, I've been holding it mostly in cash over the last 2 years, not in equities, because it's been in this downtrend. And then when you get the trigger, you have to actually be willing to move quite aggressively, even when there's still a range of outcomes. We don't know if the market's going to be up 20% next year. I know that the odds are higher after a few years of declines. There's no crystal ball, and you can't overcommit to an expectation, but you can only invest according to the odds. And so I like to take that lens to my own investing. And that's where I am. I'm feeling more bullish basically based on the market history. But then if you actually take a more outside view and you look at interest rates, inflation cycles, and so on, there's plenty of things to be worried about. But, what do they say? They don't ring a bell at the top or the bottom. And the market is a discounting mechanism. It tends to move ahead of often the economic indicators and so on. Often it sells off before things have gone bad and before there's a recession. It starts recovering early. And the other thing about small caps as well is they often recover more quickly than large caps do because they can cut costs and be a bit more nimble. So it's an interesting time in the market right now. And I'm feeling more positive than I have for a long time. And my wife knows me as a perma bear. So that's saying something.
That was a brilliant share, that, Ed. Thank you so much. And hope the audience appreciate that, because what we've covered here is the blueprint for finding multibaggers, with you going into your own experiences of handling drawdowns and market timing. That adds an extra layer to this sort of stock picking, finding the multibaggers. And just to let everyone know that the links to watch the masterclass that Ed did on the Stockopedia YouTube channel are just below in the show notes, along with the report. But don't go anywhere yet, because we're not finished. What we're going to discuss now is, how do we apply that to today? Because this report looked over the last 10 years, and you are right, history doesn't repeat, but it certainly rhymes. So how would we take this information and apply it to today as we look for the next multibagger, or hopefully 10 multibaggers?
Yeah, absolutely. It does help if you start with a market that's got room to grow valuations. And the UK market, if you look at the price,
potentially there now.
Yeah, exactly. That's one of the reasons I'm feeling much more positive, is because you can find a lot of companies with these traits on the UK market now. And I think there is a huge amount of bearishness about the UK economy as a whole. And this is a great country. It's got fantastic legal rights, property rights. There's a lot of brilliant people, great education system. And I think that ever since Brexit, there's been a lot of sort of capital withdrawn and funds have been redeemed, and fund managers I know have been selling companies they don't want to be selling just because they've got redemptions. When there are forced sellers out there, it's a good time to actually go stock picking, starting there, understanding what you're looking for. And yeah, thanks for mentioning that we did a webinar on this topic, and then I also did 3 sort of half-hour video masterclasses that went deeper into the financial engines of multibaggers, the more softer side, the models, moats, and management of multibaggers, as well as how to screen for them. If you're not a subscriber at Stockopedia, you can take a trial and access all these things. So it's a free trial. Once you review that material, you know much more what you're looking for. Certainly what I've tried to do with the team at Stockopedia, who are all brilliant. And we've got a lot of resources on the site that can really help people in their hunt. So the stock screener is excellent. I use it every day. And, you can put together lots of financial parameters based on the many that we've shown that the multibag has displayed. Things like having a higher stock rank and being small caps and having sales growth. And then you can put other financial measures like looking at profitability and margins that aren't too high, a low forecast price earnings valuation, to try and find a set of shares that then you can go and look through. I think Warren Buffett said start at the A's and go to the Z's. So you can actually then use that to go and do your more qualitative analysis on shares. But I think before I even do the qualitative analysis, I start with a screener. And then I go and click through to the stock report, which is on the site. We've got these 1-page views with all those sort of essential financial statistics. They really give you everything to give that first glance. Do they have anything you haven't screened for? You can go and look at the margins against the sector. You can look at the debt levels. You can look at the financial history and see, are they growing? Are they quite consistent operating businesses? And you can view the sector and the chart and everything else. So that's a really fantastic lens on a stock. And then you can go off and then go to the company's investor relations website, look for presentations, get to know the business, try and assess what they do. It really does help to figure out if the management are trustworthy. Are they founders? Have they been there a long time? Are they sensible capital allocators? Because they're your agent as a shareholder. They really are. They act on behalf of shareholders, and you want to see they are on your side. And then you've got all the other stuff. We've got a fantastic set of writers. I know you know many of them yourself, Lee, who come on podcasts here. Our analysts are fantastic. We have a small cap report that goes out every day. We have the community and deeper dives in shares. And really, there's a huge amount of resources on the site that can really help people find multibaggers. And I think it's an interesting time because there is that anticipation that after 2 bruising years in small caps, that it's going to get better. So we'll have to see if that pans out. You never know.
Fingers crossed.
You can only play with the odds and place your kind of bets accordingly.
Yeah. You mentioned earlier in the conversation stock ranks, and that was born out of the pain that you went through. Would you just explain what they are? Because I'm quite curious to understand a little bit more about them.
Yeah, of course. We were really inspired at Stockopedia by some services across in America that provided rankings on US shares, and the Value Line ranks and Zacks, and there are a variety of businesses over there, but they never covered the UK. I felt like, having poured through all the academic research and loads of literature, that I thought there was an opportunity to do something that was based much, much more closely and keenly on all the findings from academic research. So lots of these academic finance researchers have won Nobel Prizes for economics and things. And some of them have gone off and started hedge funds, and they apply all these principles. And so we used a lot of that literature to compose rankings for quality, value, and momentum, as well as a composite called the stock rank. And we basically use a lot of different financial traits like fundamental characteristics. For example, the quality rank, looking at their profitability, looking at their leverage, looking at a range of things, their fundamental momentum and more, into a composite measure of quality, which ranks all the companies from 0 to 100 as best, as percentiles. And similarly for their valuation across the yield, the price earnings ratio, price to sales, measures like that, bundle all into a value rank. And similarly on momentum, which is both price momentum and also the momentum of what's called earnings momentum, which is, are they beating the numbers? And are they beating the forecasts? Are they beating what the analysts say in the city? And these have been just tremendously effective. When we launched them, I had back tested them on various international markets, but I didn't expect them to have performed as well. So the 90 plus ranked shares in the UK have returned on average about 11% annualized. Whereas the lowest ranked, I don't have a number actually at hand, but I think it's minus 17% annualized. So there's this huge spread across all the different ranking groups of 10, which has been extraordinary to watch unfold through time. And it's really also because we cover international markets too. They work in almost all international markets. And that's very much aligned with what academic research has all shown, but we've shown it in real time, publishing the ranks every day and making them available. For me, if I'm being purely systematic, I'll only invest in 90 plus ranked shares. But if I'm stock picking, I'll always be looking at shares in the top third of the market. I played a lot of cards, I played a lot of poker. I like odds and I like statistics. And so knowing the base rates in the market, if you are loading your portfolio with low ranked shares, you are fighting against a massive headwind. Whereas if you're more loaded with higher ranked shares, you may have more of a tailwind behind you. Doesn't mean they're all going to be winners. It just means that you've got the odds on your side.
One thing I've noticed with the private investors that I've had on here as the podcast is quite a lot of them are big proponents of founder-led companies because the founder is passionate about what they do. They live and breathe it. And that is exactly what I'm getting from you. You absolutely love this.
Yeah,
and
I
the
do.
fact that you are putting your experience, your expertise, your knowledge into the actual product, but with testing as well. Yeah, this is what I'm picking up from it. So it's fantastic to see.
I do. I absolutely love it. I just,
Yeah.
the thing about markets and especially equities, there's so much psychology, there's so much data. And the great thing about Stockopedia, I've got a real design ethos as a painter as a kid. And we've now got a brilliant designer, Greg, who leads our design at Stockopedia. But we just got a brilliant team who really care about finer details of things. And, you get that kind of synthesis of data, education, what works, design, and you're able to bring it all together. And then, of course, all the content work and research. And I've just always tried to build a service designed around what really works through history and hopefully for the future too. And yeah, well, I'm glad you picked up on it because I really care about it. And it's great fun. And there's always something to learn. That's the thing.
Yeah.
There's always more to learn and more to investigate. And the markets are always changing. It's just really exciting.
You use these tools for your own portfolios, for your family. So it's people probably may not have noticed that Stockopedia is a founder-led business. And here is Ed. Ed, this has been brilliant. I've really enjoyed this. Is there anything you think that we might have missed?
Probably taken up far too much. It's great fun. It's great to just chat these things through. I've really enjoyed it. Delighted to spend time with you, Lee, and talk about all of this. And thanks to everyone who's listening and everybody, when you're investing, just have courage and believe in what's always worked and good times will come again. Certainly what I think.
I did pick up that you mentioned just a little bit earlier that the 3 webinars, the masterclasses that you did for Stockopedia subscribers, you mentioned that you'd be happy to share with anyone who signs up for a trial. Is that okay? If anyone signs up for a trial, they'll get access to the 3 private masterclasses?
Yeah, absolutely. I think the team will send the link to those, definitely. And I recommend them. I put a ton of work into them with the team and they're good stuff. So I learned a lot and I think everybody would learn a lot watching them.
So there you go. The link for the trial, just below in the show notes, along with the masterclass. It's worth taking a trial just to get access to those. In my humble opinion, I've seen them. They are amazing. They're really good. So it's worth taking a trial just to see them. Ed, thank you very much.
Lee, thanks so much for having me. Cheers.
Well, that's it for another episode. If you want to take up the very kind offer from Ed for a 2-week trial, including access to the 3 private investor masterclasses that Ed recorded for the Stockopedia subscribers, Class 1 covered in detail the financial engine that drives long-term compounders, Class 2 covered competitive advantages, management and capital allocation, and Class 3 covered how you can screen for the next multibagger. They're really insightful, and I have no doubt they will help you in your search for your next long-term winner. Just scroll down to the bottom of the show notes, you'll find the link to the free trial. Hope you've enjoyed this episode. I look forward to bringing you more great guests in our next episode.